Oil and gas is awesome because it provides higher cash flow initially and it's monthly, which is really nice. So it's a great way to diversify your portfolio.
Hey everyone, welcome to Investing for Generational Wealth. My name is Keshav Kalor and I'm joined by my co-host, John Lai
Hey, bud.
from Clive Capital, where we help high earners just like you invest outside the stock market to passively achieve long-term wealth through superior risk-adjusted returns, long-term passive income, and a huge topic for today, tax benefits. So far, we've helped our investors invest into over 900 apartments, actually over 1,000 apartments under renovation now, 500 single family rental homes under development, and we're expanding into industrial real estate, private debt, like fixed income, and with our very own Courtney here, oil and gas, hopefully. So before we begin, a quick disclaimer, we're not financial advisors. All investments are subject to risks, including the possible loss of the money you invest. So perform your due diligence before making any financial decisions. And of course, consult your CPA, your attorney, other professionals in your life before beginning investments. My friends, John and Courtney and I, we're just here chopping it up, having an educational time. This is not advice. So welcome to today's episode, Fueling what are we calling it? Fueling wealth. I love these names from ChatGPT. Fueling wealth. How oil and gas investments can reduce taxes and provide pretty good returns too. But again, we're not CPAs. So with that, today we have our guest and my friend Courtney here. Thank you for joining us, Courtney.
Yeah, thank you so much for having me. I love providing education in this space. You know, oil and gas is such a special asset class, and a lot of people don't realize the tax benefits and cash flow, and it's so different from real estate, but it's a great asset if you can find the right opportunities. It's a great way to diversify your portfolio. So I'm going to share my screen in just a second, but I do want to give a little bit of background on myself and where I came from, how I even got into syndicating oil and gas. You can see a lot of my stuff in the background. These are hard hats that were my dad's. So I'm originally from Midland, Texas, and my dad was a petroleum engineer. And gosh, I grew up, we have done nothing but drill oil my entire life. My dad was a petroleum engineer. My brother drilled oil. I don't know if anybody's watching the new episode or series called Landman, but you know, the new kids that start off with no experience, they're what they call worms. And then he had worked his way up to tool pusher. And, you know, my uncle has a well servicing company, and we've lived in Abu Dhabi and Pakistan. My dad drilled in Jakarta for 20 years before he retired. And so this is all my whole family has ever done. And about 12 years ago, I inherited my dad's oil and gas company, and we've continued to drill throughout West Texas in the Permian Basin, which is the number one producing area in the United States. And so it just kind of made sense to keep on going and keep doing what I'm doing. But what happened was my entire portfolio was in oil and gas, and it hit me pretty hard in 2016 because, you know, prices went down, you know, sanctions against Iran were lifted, and it hit the price of oil hard. And everything I had was in oil and gas. So I was looking to try to figure out, you know, how do I diversify? And that way we're not completely dependent on the price of oil. So not to scare anybody, everybody's always like, gosh, oil is so great. Why don't you have everything in oil? And I'm like, because I've lived through the ups and the downs of that. And, you know, diversification is important. But through that investment journey, I was looking to get into more real estate and things like that. And then I figured out, I don't know what the heck a cap rate is. Like, I don't even know all of this stuff. I don't know how to do the due diligence. I don't know how to assess it. And that was actually the point where I really had a great understanding of the tax benefits and some of the additional things that, you know, oil and gas bring. And I thought, you know what, I'm just going to stay in my lane, figure out how I can bring these investment opportunities to other people because it has the chance to really help you retain money. And in my mind, it's all about that momentum, you know, momentum and velocity of money. And oil and gas has the ability to help you do that. So, you know, for me personally, I like to deploy capital into oil and gas, get it back pretty quickly, and then redeploy it into real estate. And so now I have funded two different assets with the same capital in a pretty, you know, relatively quick timeline. So that's kind of where I'm at. So I started syndicating oil and gas a few years ago, and here we are. I think our strategy is pretty solid. And so today I really just kind of want to talk about why oil and gas. What do the risks look like? What are the things you need to look for? And how are we doing due diligence? And how are we even assessing the deals that we're getting into? So, is it okay if I share my screen? I have, I don't know, like 10, 15 slides, nothing crazy, but I'm a visual person and it does me a whole lot better to actually see what I'm talking about.
Yeah, please do. You should have. There we go.
I got it. All right. I
And
will
as
tell you.
everyone has questions, feel free to drop your questions in the Q&A, and then we'll answer them at the end or as we go along.
Perfect. So let's talk about why we even want to look at oil and gas. So, first of all, it's a great way to diversify. One of my favorite things is the income from it. Oil and gas pays monthly. The first time I invested into a multifamily deal, and this is not a knock on multifamily, this is totally a knock on me because I didn't understand what I was investing in and I didn't understand how to do the due diligence. And I think one of the $100,000 investments I made was paying like 750 quarterly, and I was like, "What is this? What am I supposed to do with that?" But really, real estate, it does provide the cash flow, but you get more of the upside when you divest at the end, which is beautiful. Oil and gas is awesome because it provides higher cash flow initially and it's monthly, which is really nice. So it's a great way to diversify your portfolio. And typically, oil and gas is opposite of what real estate's doing. Like a lot of my real estate investments are struggling right now. We've been hit pretty hard with the interest rate rises and insurance costs and things like that. But that's okay. These all of these different asset classes are cyclical. Oil and gas has been really strong for me through that time period, which has been really great. So at some point in time, the price of oil is going to come back down, but I've got cash flow coming in from real estate and I've got those assets divesting as well. So they all just kind of work. I'm working to build a really good, robust portfolio of oil and gas and real estate. So that high potential ROI and passive income is amazing. And the great thing is it's a really good hedge against inflation also. So oil is in just about every product that we use. I mean, it is in everything. It's not just in the fuel in your car. And, a barrel of oil is about 42 gallons. And these are really rough numbers. It's not exact, but about a third of it is, fuel for cars. About another third is diesel and jet fuel. So tractors and farming equipment and airplanes. And then the other third goes into all these different products that we use, like asphalt and tape and sports balls, makeup, medical equipment. It is in just about everything. So we need it. And so when you've got inflation, because the way that oil is tied into all these products, it's a really good hedge against inflation. So a lot of commodities are. And then there's the tax advantages. The tax advantages are amazing. We're going to dive into those a little bit deeper here in just a minute. I've got some great, K1s and things like that to give you a good idea of how those tax advantages work. So the oil and gas criteria, I see a handful of different oil and gas opportunities out there all the time. And I get so many sent to me all the time. Investors are always asking me, how do we diversify or how do we even assess this deal? How do we do the due diligence? And, Keshav and I, we're going to be working on these oil and gas deals together. And so this is kind of this is just a partial list of my oil and gas criteria when I'm looking at something, let me see if I have this next slide. I do. Okay. I had to go back and double check. I've only presented this a couple of times, so I couldn't remember what my next slide was. But there are major operators and then there are small operators. And I'm never going to knock the small guys. I want to root for them. I want them to win, but I do not put investor money in small operators. And so major operators, these are billion and multi-billion dollar companies. I think we have something like 46,000 oil and gas operators in the United States. And I'm going to work with the EOGs and the Anschutzes, the ConocoPhillips of the world. These are major, major operators. Keshav invested with me in a deal last November with Anschutz. They're a $1 billion company. My next deal was they're the number three producers in Wyoming. They have thousands and thousands, of wells. EOG has drilled 39,000 wells. So these are major operators. They're producing millions of barrels of oil per day, and they have a lot of experience and they're really, really good at what they do. So we want a major operator in a proven area. And I'm going to click over to this one screen that I have. I've got two different pictures. Actually, this one's a little bit better. These areas in the middle, this Eagle Ford, Permian Basin, Anadarko, Niobrara, and Bakken are my primary, my targeted five areas that I'm looking at. My last three deals have been in the Niobrara. The majority of my personal holdings are in the Permian Basin, but these are proven areas. They're proven to have oil. They have the infrastructure in place to pipe oil out and things like that. I am never going to invest in a project if they're like, "Hey, we're drilling in Washington or we're drilling in Wisconsin." I'm not going to be a part of that. I want major operators in proven areas, and these are the proven areas that I like. I thought this map was really cool because you can really kind of get a look at what each state is doing in volume. And unfortunately, this is a few years old. Our numbers are even higher now than they were in 2020, but you get a better idea. Texas is the top, that Permian Basin, along with some of the other areas that we have, they're major, major producers. So somebody's going, "Hey, we're drilling in Alabama," that's okay. Georgia, South Carolina, any of these places, I'm not going to drill there. We're going to stick with the major good areas that we know of. Let's see here. Experts in the area. One of the things that I like to talk about, and I like to use the medical field as an analogy. You have general surgeons that can operate anywhere on the body, right? But if you need open heart surgery, you want a cardiologist. You want a specialist that specializes in the heart. Each of these different areas that you drill in, they have different nuances. The rock and the things in the ground present different types of problems, and I want to work with an operator that specializes in the area that they're drilling in. Can anybody do it? They probably can, but when you've got somebody that specializes in a specific area, they already know, they've already set aside whatever issues they are expecting to potentially have. They've already put a contingency plan in place for that, and so they do it. They drill and they get it done quickly. I think all three of the last projects that I've had in the Niobrara, which were all three different operators, I mean, they drilled long, deep wells, like 4 miles deep in roughly, gosh, our last project we just closed, they drilled four wells that were about 4 miles long each in they finished it in 29 days. That's amazing, but it's because they know what they're doing in that area. They're specialists. So you always want to find out, have the permits been approved? Have they acquired the land? Are the permits approved? Where are they at in that permitting process? Is this federal or private land? That federal or private land is going to tie more into have the permits been approved? Because if the permits haven't been approved, you could run into some bumps there. So that's a really important question to ask. Once the permits have been approved or even drilling has happened, you don't have to worry about whether really a lot of the hassles and the hoops you jump through happen during that permitting process. So if they've got permits finished, you're in pretty good shape. The LOEs, which is your lease operating expenses, that's going to be the monthly expenses used to keep those wells up and going. You want to make sure that whatever you're investing in, you've got 10% or less for your lease operating costs. And then any project you're looking at, you need to find out if the price of oil drops, and we're going to talk more about that in a minute, or if there's additional costs that come up, what contingency plan do they have in place? So when I've personally invested with some smaller operators, they didn't have the money, they didn't have the deep pockets that these major operators have. They are depending completely on investor capital to get these projects going and to keep them going. So if they don't have money set aside for things, they'll come back and do a capital call to keep that project going. This is why I like these major operators. EOG is a multi-billion-dollar company. They don't need my money to get these projects going and to keep them going. And, people are always talking about skin in the game. We're typically buying anywhere from 2 to 15% interest, which means that these operators own 85 to 95, percent of these deals, which means they're funding 85 to 95% of the deal. I mean, you talk about skin in the game. We don't have as much control over the project, but these guys are going to run that project as efficiently as they possibly can, and they're going to get every drop of oil they possibly can out of the ground because they have pretty much all the skin in the game, just about. They're very incentivized to make it as profitable as possible. So make sure you find out what that contingency plan is. Do we need saltwater disposal? Is that in place? I will never invest in something that has less than 4 wells. I know so many people that invested in an oil and gas project. It was 1 well and it ended up being dry and they lost all of their money. They got the tax benefits, but there was no income to be made. Well, when you have multiple wells in a project, even if you have one, and you're going to have one, if you've got multiple wells, you're going to have one that underperforms. I typically see you've got an underperformer, a couple of average wells, and then usually there's a rock star, super performer in that. But you want to make sure you've got multiple wells to kind of cover each other. That way, if you do have one that's underperforming, all of your eggs weren't in that one well's basket. So, and we're always looking for return of capital in an 18-ish month time frame. It could end up being 12 months, it could end up being 2 years, but 18 months is a really good time frame. And we're pricing stuff out right now at about $70 oil. If you take a look at the average price of oil for the last 5 years, it was $69. And that's even with COVID factored in when it went below zero for a brief moment. So I think if you take COVID out, it's like $74, but $70 oil is a good number to price things out and get your returns out because that's what it's consistently been for years now, which is good. We've seen higher and lower, but 70 is the average. So the offset production is all of the wells that are surrounding your wells that you're drilling. And obviously, current wells are not going to produce exactly like the wells that are around them. You can have some that produce less, you can have some that produce more, but typically for the most part, wells in an area, you have a pretty basic understanding that, okay, all of these wells in this area are going to produce 800,000 barrels or 500,000 barrels, whatever that number is. So if I've got what I'm expecting my project to do, I like to take a look at what the other wells, within a 20 to 50-mile radius of my wells, how did they perform? Did they perform? Did they meet the expectations of what I'm expecting my project to do? So I like to build out, I love a good Excel spreadsheet. So I like to build out that production for the surrounding wells and take a look at what they did and what their average was in year 1 and year 2 and year 3. Like I said, it's not going to totally dictate what my wells are going to do, but it gives us a really good idea and of what we can expect. So let's see, which brings us to this, what is the expected production? Every single project, shallow wells are much cheaper to drill than, these deep horizontal wells that have to be fracked. They are super, super expensive to frack wells, but they are going to increase the production, 2 to 7x what just some of these shallow wells. But because they're so expensive to drill, we need a lot of production for that. If you're drilling shallow wells, you might need 50 barrels a day or 100 barrels a day. A lot of the projects we're looking at, we're producing 30,000 barrels a month. We're going in at 1,000 barrels a day. So every project's going to be different. You just need to find out what that expected production is going to be, what they expect the overall production for those wells to be, and, what do you need to get the returns, for your deal or the deal that you're looking at. So, and then this is really important. That break-even price of oil for the project is, what is the price of oil? And it's the WTI, the West Texas Intermediary, is what we are trading oil on in the United States. We typically live in the $35 to $40 price range as our break-even for our project. If you're seeing stuff that's at 75, I've seen projects that had a break-even price of $80. I would probably think twice about investing at something that's got a really high break-even price. And then We want to find out, has drilling started? If not, when are they expected to drill? When are they expected to complete? Are they fracking these wells? And how quickly do they plan on doing that and then getting them online? The drilling is the longest part of the process. The fracking just typically takes a few days per well, and then they'll turn them over to production and get them online and producing. So once you get to the fracking part, the rest of it's pretty quick after that. I don't know if I can't see the chat, so I don't know if there's any questions or anything. I'm just going to keep going.
Yeah, no, none so far. We'll let you know.
All right. So just some things that I do like to look at if it's not a major operator, if you're looking at a smaller operator, this is when I start digging into the operator's production numbers. I do not pull production numbers for major operators. EOG's drilled over 39,000 wells. That would be a massive undertaking to build out a spreadsheet, which is why I look at the surrounding production and things like that. I look at it a little bit differently. But if I've got a smaller operator that we're assessing it, I want to know what their experience is, how long have they been drilling, how many wells have they produced, what are their production numbers, and then I go in and verify that. And then we'll look a little bit more here in a minute on how you can actually verify those numbers. And the most effective thing I can do is actually pick up the phone call and I start calling all of my oil and gas people that I know and I ask them about them. I ask them, what do you know about this person and this company? And it's amazing what you can find out in doing that. And then, I run background checks. I'm not running background checks on EOG. I'm not running background checks on these major operators, but on smaller operators, that's necessary. And then also, once again, where they're drilling, do we have, pipelines and the infrastructure in place? What are the formation trends for the deal? And, some projects have multiple pay zones. So they'll go in and drill to a certain area. They'll extract all of the oil out of there. Then they'll drill a little bit further into the next zone and then the next zone. So find out, how many formations there are. It might just be one. It could just be one pay zone. And the formation, yeah, just ask what that is. And then the life expectancy and production potential. This I look at for both projects. We want to know how long they expect these wells to produce and what they're expecting them to produce. And let's see, yeah, predictability of the drilling and completion cost timeline, break-even numbers. Yeah, so some of this is the same. Really, it's just this top part that's a little bit different. I do a little bit deeper dive into smaller operators and what they're doing. And typically I'm doing that for other people because they're bringing me projects to look at. I do not operate or invest with smaller companies. This was just, I think I said 46,000 operators earlier. There's actually just under 44,000 operators in the United States. And so, EOG was not the last project I did, but the one before. I mean, they're a $23 billion company. That's massive. And I don't know what their, daily production of oil is, but if these guys are at 125 and these are at 476,000 barrels, these are massive numbers. And just to put this into a little bit of perspective, the United States uses about 21 million barrels of oil per day. That is our demand, and that's what we need. Our entire country collectively produces about 13 million barrels of oil per day. So I know a lot of times you'll see articles in the news that talk about, we're producing so much, we're exporting, oil, and we export so much. Actually, we import a lot of what we use because it is cheaper for us to buy our oil from Canada. We used to buy a lot from Russia. It's cheaper to buy it than it is to refine the oil that we are producing here in the United States. And we need to do a lot of work with our refineries and things like that. But I'm not going to get into the sulfur content and things like that for oil. That's going way deeper than we need to go through in this call. But we import a lot. And the world as a whole is using about 103 million barrels of oil per day. So it's significant, and that demand continues to grow. And especially as, some of these countries, China is still coming out of, COVID and recuperating. And so that demand continues to go up. I do think here probably 10 or however many years down the road, China's population has is decreasing. So at some point in time, we are going to see that have an impact on oil. But we're looking at that, years down the road. Right now, we're in a pretty massive energy deficit, and the United States has not been exploring and drilling the way that we have needed to keep up with the increase in demand each year. So at some point in time, we're going to feel that also. So let's get into the tax benefits. This is probably everybody's favorite thing to talk about. I have so many investors that come to me. They're looking for tax benefits, because investing in a working interest in oil and gas can offset any kind of income. It's very special. You don't have to actively be involved. It can offset W-2 income, capital gains. I have active income on here because active income is always your W-2 income, but it's not always W-2 income. There are some investments and other things that you can actually receive active income from, but it can also offset passive income as well. Now, every project is going to vary. We typically live in that 80 to 85-ish, percent on our deals that we're bringing. So, and I have a great breakdown in a second that we'll get into, but that's a great tax write-off in year one, and it comes from the intangible drilling costs. So this is not the equipment and things like that. It is your fuel and labor, all of the intangible items that go into drilling those wells. That is what makes up a big portion of that write-off that you're getting in year one. Now you do end up getting all of it, but you do get that big portion in year one. And we also are able to write off the tangible drilling costs, so the equipment and things like that. But it's such a minor amount, and it's such a small number that I don't even go into it. And it's depreciated over about a 7-year time period. The other really, really great thing about oil and gas is something called a depletion allowance, which means you get a 15% depletion allowance every year in perpetuity for the life of these wells, which means you are only taxed on 85% of the income. So let's say you make $100,000 in the year after you make the investment, you're only going to be taxed on 85%, which is amazing. And it's like that every single year. And so I do have some great K1s and some other information on numbers. Let me see. So what does this mean? Let's say you're in the 37% tax bracket. A lot of my people are in, doctors and lawyers and dentists. They are trying to reduce their taxable income. I have a group from Intel that I work with on helping them, but we're going to put you all in the highest tax bracket. You make $100,000 investment and it's getting 85% depreciation. So that means it's going to reduce your taxable income from $500,000 to $415,000. So that is essentially translates into about 32,000 in real dollars that you're going to retain, that you're not going to have to pay the IRS, which is amazing. It's fantastic. And let's see, I think on this next page, I just hit the whole end. I'm sorry. Let me scooch back. I apologize. Here are a couple of K1s that are from two previous deals that were done. I wanted to go in and show you this. Actually, this one on the right is the deal that Keshav invested with me in last November. This is not your K1, but this $100,000 investment, we ended up passing along 82.7%, I guess, in depreciation. So he got an $82,000, almost $83,000 K1 loss. So it's K1s that you get them each year. For us, one of the things that I do love to brag about is we get them out by mid-March every year. So we are not battling and looking for those in, September or anything like that. Our CPAs are really good and they get this information out quickly. And we share these with everybody. I share these redacted K1s so that you can take them to your CPA and say, okay, how does this apply to my tax situation? Because we don't ever want to create, additional problems or anything like that. I don't want to make promises. We want to always make sure that this is going to impact you the way that we think that it will. And
Hey, quick question, Courtney, on the tax. There's no recapture as in real
Oh,
estate,
yes. I'm
correct?
so glad you asked that. There is not recapture. And I know we see that a lot in real estate because they can get some bonus depreciation and things like that. And if you sell it too quickly, they can come back and recapture. We do not have to worry about recapture in oil and gas because we're getting those tax benefits from drilling the wells. Well, the wells got drilled, the money got spent. So you don't have to worry about them coming back and recapturing that later. Thank you.
Uh,
I meant to mention that and I forgot.
Another one. What's the limit on like how much you could take in these losses?
Yep. So, and that's a great question also. So for W-2 income, you can offset, I believe it's $250,000 in the first or in that year. For capital gains, there's no limit. And I feel like this is just another way that the IRS punishes W-2 workers because capital gains from, you can sell real estate, sell an apartment building, you can sell $100 million in stocks and other things and have you can offset $100 million in capital gains. So there is not a limit to capital gains. And what's interesting, I had a call with the CPA here about 2 months ago, and he said he did like a 30-year research back into um, oh gosh, individuals' returns to see if there had been any audits done, and they could not find over the last 30 years any tax return that had been audited for taking this kind of, K1 loss and depreciation on their returns. So this was a very special tax code that was put in place, I believe, back in the 50s to incentivize oil and gas exploration because we need it. And I get a lot of people that ask me all the time, are electric vehicles going to eliminate our need for oil? And I'm going to tell you, it's not going to happen in my lifetime. The oil and gas industry is one of the top 10 industries in the world, not just in the United States, but in the world. And the medical pharmaceutical industry is more than $1 trillion industry, and it doesn't even come close to what oil and gas is. We are not getting rid of oil and gas with electric vehicles.
The tax benefits, because I mean I get a lot of these questions too, because I tell people about the investment I made with you and the ones we have coming up. So if W-2 has a limit, capital gains doesn't, like how about other types of active income, like business owners or anything like that?
I will have to double check on that. I don't know that I've ever been asked that. That's a really good question. I'm gonna make a quick note.
And the same thing for passive income too, because I think those are kind of the big buckets.
Yep. Sorry, I have to write this down because we'll finish and then I'll forget.
Yeah, no, you're good.
I would say that active income is probably that 250 cap with the W-2 because, W-2 is classified as active income. But I'm not sure about the passive income. I
Okay,
think
yeah.
most people are using it to offset, active. So I've never been asked. That's a great question, just because a lot of the real estate projects and things people invest in offset passive income. So it's so much easier to find, passive offsets than it is active.
Yeah.
And the other thing I do want to point out about that, the way that we have our deals structured, our investors come in as general partners. And so you've got to come in as a general partner so that you can get that active income. And then the following year, we convert our investors to limited partners. And so um, I guess the biggest question I always get around that is, well, when you think of a general partner, like in real estate or things like that, there's additional duties and things like that, and it's not that kind of a general partner. It's literally just a general partner into a limited partnership, just really for the tax purposes.
In that second year, once you convert to a limited partner, do you lose the ability to take that 60 to 80% write-off on the intangibles?
Oh, okay, wait. Say that again.
So you mentioned you go from general partner to limited partner in the following year, in year two. Do you the intangible write-offs? Do you lose the
Taking
ability to
that
take
in you're
those
yeah, well, you're taking it in year one, that
in
big
year one,
bulk of
right?
everything in year one, and it doesn't have any impact on that. So
Okay,
the reason
perfect.
for the conversion is when you come in as a general partner, you assume any and all liability for whatever goes on with the project, and it lowers your risk when you're converted to a limited partner. And when I say unlimited liability, I know that sounds really, really scary, because it's like, wow, and what does that look like? What are the some of the risks in that? And we can get into that here in just a second. So, coming in as a general partner, let's say there is a team out there drilling wells and they have a blowout and people die. I mean, things happen. I lost my brother leaving a rig in Pecos, years ago. I mean, stuff just happens. These major operators, they carry massive amounts of insurance. I have over 100 working interest wells of my own. I've never had anybody come after me for anything, but I'm not saying that it can't happen. Most of the times when I see spills happen and things like that, it's typically offshore. Um, I mean, there are things that can happen, but the biggest part of the risk is typically during that drilling process, which is another reason I like to come in when the drilling has either been finished. Not every project will be like that, but I like to come in when the drilling is already finished because that's where a lot of the risk and a lot of the issues happen is during that drilling process. And so,
We had a question that came in that is related. Um, Obviously you addressed the risk, but is it a good idea to come in as a LLC to the investment? Or
so
do you, yeah, go
that's
ahead.
a good question too. So what you want to do is you want to come in with whatever person or entity wants the tax benefits. And if it is a single member LLC, you can come in because as a disregarded entity is treated like an individual. If you come in as an LLC, the LLC will get the tax benefits. So it's wherever you need those benefits to go. Now, I do have once we convert, everybody over in the following year, you can also move it into an LLC. You can change it from an individual into an LLC also. We have some people that do that, and we have some people that do move things into trusts and that, they'll move stuff around. So that's always a possibility as well.
Got it. Okay, great. Thanks.
I
And
was
these
trying to
investments,
chat screen and I can't I have no chat screen and I have no ability to open it up and look at it. So thank you for reading the questions to me.
and these investments aren't IRA applicable, right? Like you shouldn't be using retirement accounts to invest into them.
You can. I think gosh, I don't. I think I've had probably 400 or 500 investors over this last 12 months that have invested with me. I've had one person invest with their IRA. Actually, this last deal I just closed, I had a gentleman do. He did a $200,000 investment under his personal name, and then he did an additional 100,000 under his SD IRA, his self-directed IRA. So if you invest from a tax sheltered vehicle, you're not going to be able to get those write-offs. So unless you're just coming in and you're wanting the cash flow, I don't recommend doing that. And it's also potentially, I would explore what it would look like if you pulled the money out of the IRA, as to what the tax benefits, if they're going to offset whatever hit you might take from that. I had somebody else that did that as well. They went ahead and withdrew the money and then made the investment. So definitely worth taking a look at if your money is in an IRA.
Got it. Okay. Yeah, I guess that's what I meant. That it's not you wouldn't get the tax benefits if you had invested.
Correct. Correct.
So there's a bunch more coming in.
Yeah, there's a bunch of questions coming in.
An
Um,
individual LLC, you get both active tax benefits and liability protection. Like, is it really the best of both worlds if you invest through an LLC?
It probably is. I have a disregarded entity that I invest in or that I use to invest. It's an entity that I set up in Wyoming. Wyoming has some of the best, privacy protection and things like that for people. So it's an entity I set up. I'm actually in the process of setting up an irrevocable living trust because, I want to own nothing and control everything. So I'm going down all of those, rabbit holes now, but that might be the best way. And I would even talk to your CPA or even maybe your asset protection attorney and find out what their suggestions are for you.
If the drilling is finished, I'm just gonna keep reading these off. If the drilling is finished, do you still get the tax write-off?
Yes. So, because we're coming in, even though when I say the drilling is finished, they still haven't completed the wells as long as we're coming in. So whether we joined the project before they started drilling or after they started drilling, because we're buying a working interest, we are still on the hook for those drilling costs for whatever percentage we purchased. And so yes, you definitely get it. And there's different stages of the drilling too. So we might be finished drilling, but maybe we haven't fracked the wells and things like that. So as long as we are contributing our owned percentage of that we are purchased, let's say we bought 10% in these wells, as long as we are going to be billed for that 10% for the drilling costs, then yes, you get those tax benefits. If it was, and it's going to be in that year. Now, if we were acquiring a project that was drilled the year before, then the answer would be no. There are some exceptions to that, and I won't go down too many of those rabbit holes. If we invest this year and you deploy your capital with me by December 31st, we actually have the first few months of the following year to start drilling to where you still get those tax benefits the year before. But I try to not be confusing. So there is the possibility to do that. But yeah.
Got it. Okay. Let's see.
I know with some operators, you can invest in either the intangibles or the mineral rights. Whenever you invest, do you invest with your investors, invest in both essentially, and you just do the conversion?
So we are doing specifically working interest. Working interest is the type of investment you need to offset active income. So we are very specifically doing that. Now, mineral rights and having the royalties and things like that are fantastic. And you can actually 1031 into mineral rights. You can 1031 your real estate into mineral rights, which is fantastic. And we can do that. We need a little bit more time to put it together to make sure we're finding the right minerals and things like that. But it's totally different. Mineral rights are royalties are totally different than working interest. So my main focus is working interest, but I think we're gonna help some people with some mineral rights and some 1031 exchanges this year.
Yeah, great.
Would you say generally our minimum investment amount for the deals like we're putting together and that you're leading is like 50,000?
Yeah, mine are I always have $100,000 minimum. We will make some exceptions for 50,000, especially I think especially when people are new to oil and gas. There's just there's a lot to learn. There's a lot of things to learn about the entire asset class. And so I like for people to feel comfortable and confident in not just the deal itself, but the type of investment that it is and then working with me also. So I do make exceptions, and accept $50,000 in that situation.
Okay. Yeah. I mean, that's how I got in. So I appreciate you doing that last year. And our opportunities going forward, it's going to be accredited investors only, right?
Correct.
Yep.
I'm hoping to eventually open it up to non-accredited investors, but at this point in time, we're not there yet.
Right. And then the process, just another question that's coming. The process is pretty similar to any syndication, right? You're going to get your PPM documents, subscription documents, other legal documents, and then you sign. Once we accept your signature, then you're ready to wire.
Yep, yeah, you fill out the documents. We have a landing page where you can go in and take a look at we build it out where you've got the subscription documents, wire information, some geological information on the deal. So you'll go in and fill out the documents and then send in your wire and then we countersign after that and then you'll have your copy and then on the first of the month after that, you'll get an invite to the investor portal where, once distributions start, the, monthly reports and things will be and your tax documents as well.
Okay. And I think we can go to the next one. I can answer this one.
Okay, perfect.
We are currently looking for a deal. Someone asking, we're currently looking for a deal. Courtney is leading the charge. And hopefully we find one by the end of the year. Oh, I think everyone here is looking for that, myself included. But if not this year, then, first thing next year, January or February. And I think starting next year, the goal is, Courtney, you said 3 or 4 opportunities a year.
Yeah, and we might grow that. It's always going to depend on the type of, if I can find 10 fantastic deals, I'll do 10, but if we only have, we're limited to the kind of opportunity. I'm not going to put a deal together just for the sake of putting the deal together. It's got to meet my investment criteria. I've got so many people looking for last minute depreciation, and we were working on a deal for this month, and unfortunately, somebody came in and swiped it out from underneath me. And it's the first time I've lost a deal. I was a little salty over that last week. And so. Yeah, I'm still looking for something last minute for the end of this year. I just haven't found the right opportunity yet, but I'm hopeful. I'm positive. I feel confident that I'll find something.
Cool. I know we have 10 minutes. That was a lot of questions, but yeah, let's definitely keep moving on.
Yeah, so yeah, and I see Ryan. Okay, I am going to talk very briefly about the due diligence, and then we're going to go into the risk because Ryan's asking about the volatility and pricing of oil, and that's a great question. So, let's talk a little bit about due diligence because this is another big question that I get, and when we purchase these working interests, and this is actually the deal that you are in, that you invested with me last November. So this wellbore assignment is just like when you purchase real estate. I guess you get the title to your property. It's recorded at the county appraisal district. These interests that we're purchasing are also recorded at the tax appraiser's office at the county level. So it's called a wellbore assignment, and this is several pages long. I just included this first page, but it shows how much of an interest that we own. And what's important is each one of these things, this Denver Fed, Jack Fed, these are the actual names for each of these wells. So we bought an interest. It was like a 2.5% interest in each of these 12 wells. And then this API number on the right is kind of like this serial number for that well. Now, if you come over, so every single state has a third-party governmental agency that regulates all of the oil and gas information for their state. So for Wyoming, which these wells are all in Wyoming, it is the Wyoming Oil and Gas Conservation Commission. And so I built out a spreadsheet that has links to these, but there's a lot of really, really important information. And if I move my cursor, can you see it?
Yeah.
So I give everybody direct links, but you can go in and you can search by the API number, but you see this API number and the name of the well here. But you can see that Anschutz Exploration is the operator. We've got the latitude and longitude. You can see the permit was approved on 9/26 of 22. And then the spud date is the day the drill bit actually broke ground. So that's the day they actually started drilling that well, which was in March of 2023. And they completed it in August of 2023. So this one actually came online. You can see right here it says first produced. It actually came online in August of 2023. Now, through August of 2024, this well has produced 178,000 barrels of oil and 183 MCFs of gas. Now, obviously, we're in December now, and when I built this out, this was, it runs about 45 days behind anyway, but this is, obviously a few months old. But the really great thing is you can go in and through this APD file up here at the top, you can see the surveys and find all kinds of information. I mean, really, and if you go to this display all records, you can find out, like if the wells haven't been finished, you can find out if they have, filed for permits to frack a well and things like that. So really, all of the information you could possibly want to get about these wells comes from that site. And then, like I said, our projects, we get this wellbore assignment and I share that with people so that they can see that we actually did purchase, we purchased this. You can see this recorded information. It can be verified through the appraisal district. And then when you come over here to whatever state you're drilling in, Texas, it's the Texas Railroad Commission. You can actually come in and verify everything that I'm sharing. And this is also how I verify, when we get paid, did they pay us correctly and does it match the production for these wells of what's, being reported to the federal government? This is just a map of some offset production. This was a deal that we did here in August of this year. This was a four-well project. And when I talked about that offset production, I went in and built out a spreadsheet with all of these different wells. All of these wells are wells that are, very close to our wells. And I built out a model that showed, what they produced in year one, year two, however, some of these are years old and some of these are newer wells. And so that's what I mean by offset production. How are they performing, and does that fall in line with what we're expecting from our wells? And let's see here. Oh, here's what my spreadsheet looks like. This was for that last deal. I link these out so that people can actually go in and verify the links for each of these wells and that the information that I'm providing is correct. Now, some of these, what did it do in 2015 is not very helpful in this format. So once I build this top spreadsheet out, this is where I build it out in the bottom. And it was like, okay, year one, I guess I cut my screen off, but these wells averaged about 245,000 barrels in year one. So I needed to know what we were expecting ours to produce. So this just helps kind of verify and show that this is typical for wells in this area. And then I base some of our numbers off of how those other wells have performed, along with combined information on our current project. And I know we're totally running out of time. So I'm going to roll through these risks very quickly. Um, Okay, somebody brought up the commodity price, the price of oil. So the returns are not certain, guys, and that commodity price is one of the biggest factors that impacts our returns for our project. I have absolutely no control over the price of oil, and there are a ton of things that affect it. I've had 1,000 phone calls over this last 2 months. What happens if Trump gets in office? And now that Trump has been elected, how is that going to impact the price of oil? And eventually, we normally see lower oil prices with a Republican presidency. That is very, very typical. We have a lot of stuff going on in the world right now. So Trump just coming back into office right now is not going to immediately drop oil prices. Permits have not been approved for years, and we have not continued to drill in the amounts that we have needed to meet our demand. So there's going to be a lag there. What that lag is going to look like, I don't know. But we have a lot of stuff. Couldn't sleep last night, and at 1 o'clock this morning, I read that I guess two of our naval ships were fired upon last night. They have anti-missile detection systems, and they didn't take on any damage. But we had China circling, I think it was Korea. We've got a lot of stuff going on, and war drives prices up. OPEC, I know, was supposed to meet and talk about what they were going to do with production. They have the ability to increase or slow production down. So Trump coming into office is not the only thing that has the potential to impact the price of oil. There's a lot of things that do, and it's not just one thing. So I wish I had a crystal ball and could know, but they are going to go up and down. The project Kishov is in with me. Those wells are going to produce for 20 years, which is great. Now, the year you invest, you want to have kind of a pretty good grasp on what do you think oil is going to do that year, because you get a lot of your return in that first year and two. I mean, you get a significant amount for my projects anyway. We get a lot back during that time frame. So that's why I'm pricing things out at $70 oil. I think $70 oil is a good place to be. I've been doing some deep dives. I've seen everything from bearish articles in the media on the price of oil for 2025, but I did a deep dive into that and I found some that are expecting $80 to $100 oil for 2025, and it had some really good validations and reasons. So, which way we go, I'm not sure, but that commodity price absolutely affects the returns. Now, this no assurance that oil or natural gas will be found. This and that if they do hit oil, there will be enough in there to actually bring these wells online. So this is another reason that I really, really like to come in once they finish drilling. They might not have fracked the wells and brought them online, but I love to come in once they have finished drilling because during that drilling process, they are able to determine, first of all, if they've got oil down there, and second of all, is it commercially producible? Because if it is, they will schedule the fracking and then they'll bring them online. So not all wells have to be fracked though, but they are able to determine in that drilling process if there's enough oil there or not. And if there's not, they'll plug them and move on. So by coming in where we've come in on this last several projects, it's been really good. We knew we had oil. Now I can't guarantee how much they're going to be able to pull out of the ground, but this is exactly why we want to be with these major operators. You know, when you've got a project with Anschutz or EOG or Continental Phillips, and they've got 50, 80, $100 million into a project. They have got the top of the line landmen and geologists. They are not out wildcatting. And can they potentially drill a dry hole? Yes, but they have a pretty good idea of what they're going after. And I think the potential for a dry hole is much smaller, you know, much smaller potential with these major operators than it is with some of these smaller operators, just because of the technology and equipment and geologists and everything that these major companies have access to. And fortunately, right now we've done 20 wells this way, and we're 20 for 20 as of now. So I'm really happy with how this has gone. If you haven't drilled yet, you can have delays in drilling. You know, drill bits break, there's problems. Sometimes they've got to pull all the pipe out, and there's just things that can happen and you can have delays. Another reason I like major operators, when stuff breaks, they've got, you know, extras on hand and they just plug and play and they go right along and you never even saw a hitch in the operations. They move through it very, very quickly. Now, this last thing on here is probably the most important risk that I do want to talk about outside of that commodity price. And this is earlier I mentioned lease operating expenses. When you have a working interest, that means you have the monthly expenses to keep that well going. You know, they come in and they service the pump jacks and, you know, we get a bill every month for the maintenance of that well. Now, and this is why that break even price matters. So let's say ours is $40. If the price of oil drops to under $40 and it stays there, that means we are not going to be producing enough oil to cover those monthly operating expenses. And so I've only ever had to write a check one time in my 12 years of owning my own interest, and it was back in 2016 when I got hammered. I didn't have to during 2020, but I know other people that did. Um, and we call them capital calls in our documents. This is not like a real estate capital call where you've got to turn around and cut a 25 or $50,000 check. Typically on, and this is going to vary. So this is just kind of high level numbers. On a $100,000 investment, your share of the monthly operating expenses is probably about $1,000, but it also depends on the size of the project as well. Now, at $40 oil, or let's say $30 oil, maybe we're only making 500 bucks. So your share of those expenses is $500. Well, nobody wants to not only not make money, but then have to cut a check. That really sucks. I've had that, like I said, I've had it happen once. We do retain reserves. So if something like that happens, we can cover that expense. And in my partner's DW, you know, in the history since 2008, they've never had to do a capital call. They've always had the reserves there to cover any additional expenses that might happen, because they did get hit on a couple of projects during 2020 when the prices of oil went below zero. The other thing I want to point out about that too is they're just regular fluctuations are not going to impact the return. So if it dips down to $20 and then comes back up relatively quickly, it's not going to impact it, because these oil and gas companies are locking in, you know, 30, 60-day contracts for the sale of oil. So the regular fluctuations in price on the WTI are not going to impact it. It's when it drops and stays there. And so go
Are there
ahead.
any recommendations that you would make to investors like, hey, you should keep X% of your capital invested aside for any capital calls, or is it a pretty
Well, I mean,
negligible
we
amount?
keep a pretty good amount of reserves, for every project varies and it is different. So, I mean, we keep reserves in order to cover something like that should it happen or like if and when it does happen, because eventually, you have wells for 20 years. At some point in time, the price is going to drop really low. It's cyclical. We're going to have really high times and really low times. For me, I think the one time I did have to cut a check, it was like a $1,500 check, and but that sucked. I went from making $50,000 in one month to now I'm having to, not only did I not make the money, but I had to cut a $1,500 check, and that was really, really painful. I was um not very smart with my money at that time, and it had a pretty massive impact on my family, and that's another story for another time, but another reason why I have shifted, my strategies and done things a little bit differently.
Investments in oil and gas are not like real estate where there's a fixed time frame, correct? Because you can and typically you do hold these into perpetuity.
We hold them into perpetuity. So I know there are some projects out there, they have, a divestiture after 5 years or, something like that. Most of my projects are 3 to 4x, with the majority of that paying out in like we'll call it 7 to 10 years, depending on the price of oil. And so if I'm getting that much of my money back and multiplying it in that time period, and they want to continue to send me monthly checks for 10 more years after that, like I will take that check for as long as they want to give it to me. So, with oil and gas, you're getting your capital back pretty quickly, and doubling and tripling it pretty quickly. So to me, that's really kind of that divestiture that's happening more at the beginning or even within that same time frame. But then the checks just continue to come, which is nice.
And if investors wanted to exit at some point, if oil got really low, is that just subject to typical syndication rules where you might have to find someone else to buy your shares in the syndication from you?
Yeah, I will have to, and I knew the answer to this because I talked about this with somebody like 6 months ago. I can't remember what our rules are specifically on that. I'll have to go back and double check. But let's say 10 years down the road, um, we've depleted whatever reserves we have and the price of oil is down and there is a $500 bill that you're getting and you're like, I don't even want out of this project. Our documents do say that if you do not make that contribution, if that were to happen, that you lose your interest in the deal. And I have a lot of people that are like, what? And I will tell you, I had an interest that I inherited from my dad about 12 years ago, and we had gotten a bill. I didn't know what it was. It came to his PO box. It got overlooked, and they took the interest from me because I didn't make the payment. So that is very, very typical, not just in syndications, but with all of these oil and gas companies. If they send you a bill and you don't pay it, they're going to take your interest. So if you didn't want to be a part of the project anymore, I guess that would be one way that you could exit is just not pay it and be like, I'm giving up, my interest. But I think you can sell it to another investor. I need to double check on that though.
Got it. Okay.
You've talked a little bit about this, but what does a typical investment look like? The time horizon.
Yep. So let's see. Typically, we acquire something when they're either part of the way or they've just finished the drilling process. And so I'll give you, here is a good example. Our last deal I purchased at the end of September. They had started drilling September 6th. They finished drilling all the wells on October 7th, I believe. Fracked them all October 15th, and we know they're all online now, and I'm thinking they'll start paying out in probably March. So they're usually online for about 3 months, and then we start getting distributions. And usually that first check has, 3 months of production in it. Now, this is the one caveat, each oil and gas company is different. They might start paying in 2 months, they might start paying in four. We have zero control over when those distributions start, but once they do start, they're monthly. And that first payment is always that first several months of, however long the wells have been online. But it's always that eager anticipation of, when are the payments going to start. So I would say from the time we open up a deal to the time it starts paying out is, I'm going to call it 6 months. I think that's a good average estimate.
And then in terms of, I mean, obviously the tax write-offs in year one, 60 to 80%, 85%. In terms of the returns, cash flow, is most of the payout in the first, call it 3 years?
Yes. Yeah. Yes. So they are going to produce the most in year one. So obviously, as they extract more oil out of the ground, the numbers, continually to go down and deplete over time. And every single area, depletes at a different rate. So that depletion rate is important to look at. But yeah, and that's why we're typically focused on, about an 18-ish month return of capital. The price of oil absolutely affects that. And then hopefully another, double your money and, within another 2 years after that. So it'll all vary, but we're always looking at a 3 or 4x with, like I said, 80% of that coming in within about a 7-ish year time frame. But it's going to be, your highest payout will be in year one for sure.
Hmm. Right.
Yeah, I know that, like you said, I invested 50 in it with on the Wyoming deal that you were showing, and so far I've gotten like a 20K in monthly dividends in the
Okay.
last 12 months. So that's some numbers, like a 40%
Yeah,
return.
and so yours has been online. So I know there was like one or two wells that came online in August. Most of them came online in November, when we were closing that deal out. I think it was like November 20th or November 18th, somewhere in that time frame. So even though it's been 1 year from when you invested, I think only 9 months of it has paid out yet. And so because we pay a month behind, the companies pay us a month behind, and then we pay a month behind them because they give it to us like on the 20, towards that last couple of days of the month, and we've got to get it over to our accountants so that they can divvy everything up and then, send it out. And so I think you have that 9 months represents that 20,000, 20-ish thousand is about 9 actual months of production. So
Oh, even better. Okay.
yeah.
Yeah. No, I mean, I'm not complaining. It's 40% return plus another like 20 to 40% on tax savings. It's easily my best investment so far. So,
Oh, that's awesome. I love that.
yeah. Yeah. Okay. I mean, there's plenty more questions, but I mean, I don't know. Do you have a call coming up, Courtney, or like how long
I
can?
don't. We
Okay.
can take a couple. It's up to you.
Okay. I know one question that came in, Ryan, invest 100K. What is the typical monthly payment? I could speak on my investment. That's been like probably $2,000 the first 5 or 6 months on a $50,000 investment. And then it, decreased to like 1,800, 1,600, 1,500. And then I think now it's like $1,000 a month. But what do
Yeah,
you
and
usually see?
part of that is, I mean, we were sitting down at, we went from $85 oil to $65 oil. I think we're sitting at $68 oil. So it definitely impacts it. But I do expect it eventually to come back up as well. So we won't go down and stay down forever. So
Yeah. What does the management and like syndication fees usually look like?
yep. So we do anywhere from an 8 to a 10% management fee up front instead of I mean, we don't want to do a 2% management fee for 20 years. That would be crazy. And then we take it also up front because it gets passed on as depreciation as well. And then it's an 86-14 split with investors right off the bat. And then once investors have gotten their money back, it goes to 71-29. And I know those are weird numbers. I told Rick, I was like, we need to just make this 85-15 and 70-30 because it just rolls off the tongue a lot better than 71-29, but it is what it is.
Okay.
And that's it. That's all there is. We don't have there's not any other hidden fees in our PPM or anything like that. That is as straightforward as it gets.
Anything else that you wanted to cover beyond the risks?
No, I think I think that was the final thing. So if there's anything that anybody, any other questions that anybody, I'm gonna stop sharing. There's any other questions anybody else wants to hit? They're really, really good questions. We
Okay.
can or we can call it a day. Or if anything else, pops up, you're always willing, happy to, you're welcome to text me, email me, call me, whatever.
So I guess we'll round out with some of the questions we like to ask all of our guests. So what were some of the failures that you've had over your oil and gas journey, and how did you overcome them? What did you learn from them?
Oh, this is the most painful question ever. So, my biggest lesson that I learned when I very first got into syndication a few years ago, the very first couple of deals that I did was with the same group, and it turned out to be a Ponzi scheme. And that we were able to figure it out. And they were smaller, $1.4 million deals. When I was working on in March of last year, we were working on a bigger $5.2 million deal, and we ended up terminating because, we started getting the production reports and things from the previous deals, and I was like, this is all internally generated. And they were saying that there was a lot of stuff that was under an NDA. There was a lot of really big names involved. I was really honored that I got to be a part of their deal. And I think it will end up being a Netflix special one of these days. But I think as a new person to the space, I think I didn't have the confidence to question things, and they were telling me things were fine and everything was good. And I was actually the only one that ended up terminating that deal. All the other syndicators that were involved, moved forward, that were currently, raising for them, which was unfortunate. But I'm very thankful that we terminated that big deal. But I will tell you, it has caused me to do my due diligence in a different way, and to demand the things that I demand. And if people aren't willing to give me that information, I'm out. I walk away. And where I think I tell you what, when the SEC is asking you stuff and you're like, wow, fortunately, going through that, I knew something was off, and I did a lot of recordings, and I've actually turned all of that over to the SEC. But I am very confident in what I'm doing, and I have a list of demands, and I get that stuff, and we either get it or we aren't working together and we're not moving forward. And so, that was a big learning lesson. And the other thing I learned is just because somebody's standing on stage, doesn't mean that they're a good person. It doesn't mean that they know what they're doing, and that they've been vetted. And just because they're famous and they might have hundreds of thousands of followers also doesn't give them any grounding. So that was another big lesson that I learned with that. I know there's a whole lot of lessons. We could go into the whole lot of lessons that I learned through that, but those were my two biggest things.
Is this that one operator that we've talked about that's pretty prevalent, that other
Still
syndicators?
today?
Yeah.
Nope, that's a different one.
Okay. Okay.
That is a different one, but and they're actively raising still. I think we'll see that one as a Netflix special one of these days. But and it's unfortunate. It's really unfortunate. But that previous experience that I went through is what caused me to create this kind of checklist that I go through. And by going through that checklist for that other operator is how I found out about their SEC violations and their cease and desist. When I did background checks initially, none of that came up, but it was through those phone calls and through the other steps that I created that I was able to uncover that information.
Yeah. All that to say, especially important to do your due diligence in the oil and gas industry.
At 100%.
Yeah.
And to
And
invest with experts, right?
Invest
Like yourself.
invest with 100%. This first deal, I talk about stages and things. This guy sat on the US Department of Energy board. He was an attorney, he was the mayor of his town, and the names that were tied in with that are very, very popular, very well-known names. And like I said, I was so honored to be included in this very small group because it was a very small, limited number of people that they were working with. And I was just so excited to be a part of it. It was so stupid. I don't look at it that way anymore, or working with other people as well.
and what would you say, like, how do you give back to your community?
Ooh, that's a really, really good question. I we just created a nonprofit with Catherine Bell and some of the other women that are in our group, and we do a bunch of different things. My family, we give blood and we do a lot of different donations. We're heavily involved with our church. But one of the things that I'm really passionate about, and one of our nonprofit that we created was to put together investments that not only are great investments, but also have a great impact on communities and things like that. And we don't have all of that worked out, and but we're working on it. And investing for impact. And I feel really strongly about creating, financial education for kids. I don't know what that looks like yet either, but I want to create it. I want to work with some other people to do that just so that these younger kids, and I'm trying to teach my kids. My oldest one's 29 and my youngest one's 16. And as I'm going through and even continuing to learn, as I grow and am doing things, I want to make sure that my kids are headed down the right path and they're making smart choices with their money, and that they are going down the path that's going to help them build wealth. Money is not evil. You hear that, money is the root of all evil. And that's so not true. Catherine Bell says, money is like oxygen. The more you have, the easier it is to breathe, and the more impact you can have on communities, and the more good you can do with it. So, that is, I'm all about impact and legacy and building that and teaching not only my kids, but, the next generation as well.
Yeah, that's amazing to hear.
Thanks.
I've been thinking about putting a course together as well for like finances and investing. Maybe that's something we should talk about, syndications.
We should. I'm always looking at, what are those little things that you can do now? And some of it's as simple as, paying your kids and putting it into a Roth, or, something like that, or maybe even to a 529 where it can be converted into a different type of plan when they turn 18. And when they've been making that income, they now have income and experience if they've been a part of your business, and they can even qualify to purchase rental properties. And there's just so many different strategies and different things you can tweak and do. I actually just funded my very first whole life policy yesterday. I'm so excited about being able to use life insurance to fund investments and things like that. So every single dollar I put into my ecosystem stays in my ecosystem forever, and it's creating, the ability to borrow, and it's creating, death benefit for my kids. So it's an instant benefit for them too. So anyway, we could talk all kinds of different things, but I'm always learning, and it's one of my favorite things to do is to strategize and take in those tips and how are we going to build wealth? How do we do it faster? And then teaching my kids to do it too.
Yeah, definitely. I put a variable life insurance policy together last year, so that's been good too.
Yeah, that's
Yeah,
awesome.
cool. And for those who are interested in learning more about what you do, how can they contact you?
I'm on LinkedIn. I have a website, CourtneyMoeller.com, and I would say probably the best thing is to just go through you, and we can do more calls, or if we need to sometime, we can do an FAQ. I think coming on together, that I think it's, yeah, I would say reach out to you. But I do have a website and I am on LinkedIn. I will tell you, I am the worst about checking my LinkedIn messages. And so it's not intentional. If you message me on there and I don't respond, eventually I will check it, I promise.
That sounds good. We'll include Courtney's contact information in the show notes. And Courtney, personally, I just want to thank you for introducing me to this world of oil and gas. Like I mentioned, it's my best investment so far, even though we've invested into all that real estate.
Well,
And the
good.
tax benefits are unparalleled, and it's really opened up my mind to what's possible. And then I know a lot of our investors, that's something they're interested in as
I'm
well.
really glad to hear that, because it has been a refined strategy through experience and personal loss and personal gain, and all of that. And I think we've come up with something that is really good and really special. So I'm really excited to pass that along to other people.
Yeah, yeah. I'm really excited for these deals. Hopefully we could find one by the end of the year, but if not, next
We
year
will.
we'll
I am putting it out there. We are manifesting a deal for the end of this year.
Yeah,
yeah.
our investors are craving a deal like this.
Yes, yes, mine are too. I don't know how many emails I got yesterday. When are you opening up your deal? And I'm like, oh gosh, okay, come on, bring it to me.
If there's anyone who could do it, it's you. So in Courtney, we believe.
Yeah, yeah, yes, it's gonna happen. I sprayed myself in money spray last night. The last time I sprayed that stuff, great things happened. So I'm just doing everything I can. Instead of the rain dance, I'm doing the oil dance. It's happening.
Yeah. Well, this was our longest show to date. obviously, because honestly, I would say it's one of our best shows, definitely the most interesting, not something you find every day with someone who has such specialized knowledge in a pretty opaque and at times kind of sinister industry, depending on, again, who you work with. So,
Sure. No, and
yeah,
we could talk for a whole nother hour. So I know there were probably things that I missed, but it's a lot of information. It's great. Thank you again for having me. I'm really looking forward to working with you both and your investors in bringing this very special asset class to them, and providing them the education so that they can feel good and confident about what they're investing in.
yeah, that's most important. So, thanks again, Courtney, for joining us. And we're going to include Courtney's information, contact information at when we upload this episode to YouTube and all the podcasting platforms. Feel free to reach out to me or John as well, or Courtney with any questions, and let's all get into some oil and gas together. So thanks again for joining, Courtney, and educating us about fueling your wealth growth. For those of you listening at home, don't forget to like and subscribe to our podcast. Leave us a review from wherever you're listening on whatever platform to make sure that we can continue bringing you the best educational content. So until next time, keep learning to invest for generational wealth.